Today, I'm answering a great question from Otney. Otney's asking about the IRS standard amounts. Now, before I get into the specific of Otney's question, which is a great one, I want to paint the picture here, kind of explain the context for this for those of you who may not be aware. So, when you're trying to negotiate a hardship-based resolution with the IRS, right, an offer in compromise, a partial payment installment agreement, I think that's actually the video that Otney commented on of mine, currently non-collectible status, right? Let's talk about a PPIA. Let's just use that for sake of example. Let's say you're going for a PPIA and you think you should only have to pay the IRS $100 a month. You're going to have to prove to the IRS that A, you don't have any accessible equity and assets to pay them off with, and B, that your monthly disposable income is only $100 a month. If the IRS finds that your monthly disposable income is $1,000 a month, they're going to reject your $100 a month proposal and probably expect something closer to $1,000 a month for you to pay. Now, the calculation of this monthly disposable income does not mirror reality, okay? Because you might be thinking, I have no disposable income. I'm broke. I'm paycheck to paycheck every month. Well, first of all, the IRS is going to just completely reject lots of expenses right off the top, okay? Oh, your credit card payment for your vacation that you put your vacation on, your summer vacation on, right? You got to pay us, the IRS, before you pay your credit card company, right? So it's going to back out a lot of these expenses, right? And even the expenses, legitimate expenses, like let's say housing that you do pay for, the IRS is going to limit the amount that you can reduce your monthly disposable income by for, say, your housing expense by a standard amount. Is this confusing? Let me show you what I mean. So this is the IRS standards for California, housing standards for California, effective April 22nd, 2024. These get updated every April. If you're watching this in April 2025 or beyond, the numbers are different. So let's say you live in Alameda County, California, and let's say, like me, you're a family of 5, right? Mom, dad, 3 kids. Let's say you pay for all of your housing expenses. This is your mortgage, right? Your monthly principal, interest, taxes, insurance, right? This includes cell phone bill. This also includes utilities, right, that you pay monthly, maintenance, cleaning, landscape, and things like that. That all goes into this housing pot, right? What if you add all those things together and it's $6,000? The IRS is very likely to say, from your, let's say, $10,000 household income, we're not going to let you deduct $6,000 in calculating your monthly disposable income. We're going to cap your housing expense at $4,723. Okay? It stinks, right? It stinks. Now, there are some instances in which we can get the IRS to agree to the higher amount. Like, for example, if we can say, hey, look, this family, one of their kids is special needs and they need to be in close proximity to this particular school. If they move too far away, it's not going to work. Maybe they're not going to get into that school. Like there's certain arguments you can make, right? Or or if they own their home, right? And their mortgage is their mortgage, but then you could say, hey, they can't find any rent that's more than their mortgage, right, in the surrounding vicinity, without, the sole breadwinner then having to have an even longer commute. Like there's some argument. Sometimes you can make arguments, but typically it's an uphill battle to convince the IRS to take more than whatever that standard amount is. So now they kind of understand what these standard amounts are. And it's not only for housing, okay? They have them for out-of-pocket health care. They have this for vehicle ownership expense, for vehicle operating expense. And there's also something called the national standard amount. And that is the nature of Otney's question. So let's get Otney's question back on the screen here. Otney says, what if you pay less than a standard amount? Do they count the difference as disposable income? The IRS website says, taxpayers are allowed the total national standards amount monthly for their family size without questioning the amounts they actually spend. But a phone call to them said different. So, Otney, That sentence that you quoted right there is about the national standard. This is different than the local housing standards say. The national standards are over here. These standards are the same by household size everywhere in the country. It's the same in Alameda County, California, where we just looked at the local thing for, as it is in New York, as it is in Middle America, right? It's the same everywhere, this national standard. It does get updated every year as well, around April time. And this is what they're saying, Otney. Well, first of all, what is the national standard? The national standard is the amount that the IRS basically gives you or assumes you spend for purposes of calculating disposable income on food, housekeeping supplies, apparel and services, personal care products and services, and miscellaneous. Okay? So if you're a one-person household and you only spend, for all these things on a monthly basis, you only spend $600, doesn't matter. IRS will still give you $808 without you having to prove that you spent $808, which you couldn't because you only spent $600. So Otney, it's with respect to this national standards amount. Okay? It's with respect only to this national standards amount, where you read taxpayers are allowed the total national standards amount monthly for their family size without questioning the amounts they actually spend. Okay? Now, so if you spend less than the national standard, they're just going to give you the national standard. Okay? Sometimes there's a stickler on the phone at ACS, and we just tell them the amounts, right? We literally tell them 458 for food, 44 for housekeeping, 87 for, and they don't question it, right? Because it is IRS policy to not question it. Now, if you want to claim more than the national standard, okay, like for food or something, you got to prove it, and there's got to be a good reason why you have to pay more than $458. This is for a one-person household for food. Hey, I have to eat a special diet. This special diet, and I have a doctor's note saying I need to follow this special diet for my health. And this special diet I'm on, the ingredients in the food and everything cost more than food, incurred by the average American, right? There's got to be a reason for it, okay? So going back to your question, Otney, if you pay less for food, housekeeping, personal supplies, miscellaneous, those things in the national standard, you'll still get the national standard, okay? And if the person on the phone with the IRS is telling you otherwise, I would just refer to them to this page, right? But if you're talking about some other and another one is the out-of-pocket healthcare standard, okay? These are national standards, all right? Now, if you're talking some other standard, okay, local standards say, if your housing standard for your family size in your county where you live, if your IRS local standard for that, that situation is $5,000, and you got some sweetheart deal, you got some rent controlled apartment or something, and you're only paying $2,000 a month total for all your housing, they're only going to give you $2,000. Okay? And, well, let me just leave it at that. I mean, there are some strategies that we employ on our side to get our clients the best deal possible. But, in terms of what I'm willing to say publicly, you are limited to that amount, right? You cannot take in excess of that amount up to the standard. All right. Same thing with vehicle operating expense. Same thing with vehicle ownership expense. Those are other local standards. So, Otney, I don't know exactly the phrasing of the question, the answer from the IRS, but that is how it is. Folks, if you find this stuff confusing, you got to grasp this stuff if you're going to get in any kind of hardship-based resolution, with the IRS. And you can learn it all yourself. I'm not saying you can't. Just like you can do your taxes yourself, you can change your oil yourself. You can never go to a restaurant again, and you can cook every meal on your own by yourself. You can do it, right? But if you do want a professional in your corner with this stuff, here at Choice Tax Relief, you'll be represented on your POA by a CPA, an EA, and a tax attorney on your POA, your power of attorney. Okay, you'll have a dedicated case manager who is your point of contact, who you can reach out to. for updates on your case. They'll also be giving you regular updates on your case. And we'll all do all this number crunching and all this for you. And we kind of know some tricks of the trade to position you in the best possible light with the IRS when it comes to a resolution. So folks, if you owe at least $10,000 in back taxes, give us a call at Choice Tax Relief. You qualify for a free consultation, 866-8000-TAX. That's 866-8000-829. Or visit choicetaxrelief.com and fill out the form on the website, and we will reach out to you. There are some other videos here on the left-hand side of your screen if you want to continue to educate yourself, which I recommend you do. Thank you so much for watching, everybody. I'll see you in the next video. Bye-bye.